In a debt spiral, you need quantitative easing infinity. COVID was about 4 times the size of the money printing that took place in the Great Financial Crisis, but the next one will require a far bigger monetary response. And in order to hedge yourself against that, you need hard assets like Bitcoin, gold, and silver. They don't teach you that in school. They can't. Nope. If they taught you, everyone would question the incentives of these central bankers. Like, why are you just continuing to gaslight us and to punish future generations at the expense of your old, wrinkled policies? This is why we Bitcoin. It's an insurance policy, and Bitcoin is the only digital asset that will provide insurance, because you know the fixed supply, you know it's decentralized, there's nobody calling the shots, changing the protocol from proof of work to proof of stake. So if you own 0 Bitcoin, you are exposing you and your family to...
I know we're running out of time, and I know you don't like to give targets per se, but given these calculations and such, what would you say is your outlook for Bitcoin, say price-wise, with your valuations?
I'll ask it in a rhetorical question. How quickly does the fiat banking system collapse? Does the US actually default on some debt? And the answer is, I don't care, because the price is going higher and it's such a rounding error. It's going up forever, Laura. Get a professional to manage money for you. You're too fucking stupid to manage your own money. Give it to a professional. It's only mathematics. And if you do understand this and you still don't own Bitcoin, I don't know what to say, dude, but you're fucking stupid. You're fucking stupid. Please don't have children, because you're fucking stupid. You're fucking stupid. And you still don't own Bitcoin? I don't know what to say, dude. You're fucking stupid.
Stack chain where you gotta be. False drop 2113. You must be out of the loop, and I think you're fucking stupid. You know that we stacking wild, fighting at that spiral. Stack chain always building. Please do not have children. You still do not own Bitcoin. Always trading shit coins. Just come on down and stack join and sit back and enjoy. Yeah, come on down and join the fun. Find the tip and add one. You just gotta avoid pity, but the math is super easy.
It's only mathematics. And if you do understand this and you still don't own Bitcoin, I don't know what to say, dude, but you're fucking stupid. You're fucking stupid. Please don't have children, because you're fucking stupid. You're fucking stupid. And you still don't own Bitcoin? I don't know what to say, dude. You're fucking stupid. You're fucking stupid. These are not hard numbers. It's only mathematics. Fucking stupid. Please don't invest money on behalf of your children. Will governments allow Bitcoin to succeed? There's governments that will embrace Bitcoin. They will be the winners. And if we can't convince the most freedom-loving government of the world, which still is the United States of America, if we can't convince them that Bitcoin is freedom and Bitcoin is hope, well, the other countries that do embrace Bitcoin will flip in the world order, and the days of the USA as being, the guiding light for everyone else in the world, well, sorry, you lost your status. And unfortunately, that typically happens around every 100 years. And it's been about 100 years since the USA has been, the global reserve currency. So if you go by statistics, there should be a flippening. I don't want that to be the case.
Bitcoin, it's not going to be an effective money. It's not an effective storeholder wealth. It's not an effective medium of exchange.
I have never been so sick to my stomach of the lying and fibbing. Ray Dalio gets on TV and says he doesn't think the solution is going to be Bitcoin, and then describes what he thinks the solution is going to be, and he describes Bitcoin. Like, this is so asinine, and I've never seen anything like this.
If you created a coin that says, okay, this is buying power that I know I could save in and put my money in over a period of time, and then I can transact in anywhere, I think that would be a good coin.
We are living in clown world 3.0, okay? And the people running this clown world need to be challenged by the people who understand mathematics. And it's not difficult math, guys. It's grade 11 math. So please keep challenging these people. They're lying through their teeth.
And what I've, pretty much...
It's absolutely 100% certain that the fiat Ponzi will fail. It's just a matter of when. I like to think of Bitcoin as an insurance policy on the fiat Ponzi. And it's like owning fire insurance on your house. You don't ever want your house to burn down, but let's say you see on the other side of a valley a forest fire. Well, if the forest fire is approaching your house, you know that you're in trouble. You'd certainly want to own insurance. And you don't trade that insurance. You keep that insurance. And I like to think of Bitcoin as the same thing. It's insurance on the fiat Ponzi. It's extremely cheap, and yet lots of people are inclined to buy and sell it. And I'm like, you don't sell your fire insurance on your house, much like you don't sell Bitcoin as your insurance policy on the fiat Ponzi. The global bond index has never been down more than 2% on an annual basis in the last 30 years. This year, it's down 14%. And it is getting destroyed. Total debt in the world is 400 trillion US dollars. Okay? 400 trillion. Just assuming that global debt, and it doesn't, but I'm going to simplify things. Assume that global debt mimics the global bond market, and the total debt is down 10% on a mark-to-market basis. That's $40 trillion of global wealth that has been marked down in price because of an increase in interest rates at the central bank shenanigan factory. Okay? These people finally got off of negative interest rates in Europe, and they're wondering, oh my goodness, how is this happening? Guess why it's happening, you knuckleheads? Because you manipulated the price of capital, or the discount rate for capital, into negative territory. It's shameful, but true. So bonds are now a risk asset, and people are going to need to find assets that insure against other assets losing their value. As you know, I've said for a long time, from a credit perspective, I believe Bitcoin to be default protection on a basket of fiat currencies.
Foss, you've been in a risk chair for a long time, and from my estimates, you were around when Bear Stearns went down and Lehman. So I was wondering if you could maybe talk about, Sean, you were there too. So I wonder if you guys could talk about your experience back then and maybe talk about the similarities to what's happening today in the crypto markets, and just what is contagion in the credit markets exactly.
Yeah, sure. So, and it is true, Sean and I worked together literally 25 years ago on the floor of TD Securities as credit default swap traders. And I will shout out again to Mr. Cumby. He did succeed in battling the regulators in Canada to get a exchange-listed Bitcoin fund that was the precursor to the Bitcoin ETF in Canada. So we have that over the USA. It is functioning beautifully. And at the end of the day, it's all about pricing risk, okay? So let's just build, before we go, on your statement about a zombie company. A zombie company is defined by S&P as a company that has less than 1 times interest coverage. And that's just taking its pre-tax cash flow, which is called EBITDA, and dividing it by its interest obligations on its outstanding debt. When it's 1 times or less, it is almost certain that S&P will rate it CCC, okay? The very bottom of the junk credit rating, 1 notch above default. Well, I hate to tell you people, but the USA, as an issuer, has less than 1 times interest coverage. Now, it's still rated AA+, but if it was actually rated using the same scale as corporations, the USA would be a zombie country. Now, don't fret. You're still the best zombie country at the glue factory, because Canada's even worse, and so is every other sovereign below that. So what does contagion mean? Contagion means when a issuer of credit in a jurisdiction defaults, and the knock-on effect destabilizes the entire system. Back in 2008, I worked at a hedge fund where we owned protection on certain credit, but we had bought that protection from Bear Stearns. Bear Stearns was our insurance company. We thought we were in good shape until we realized that our insurance company was going bankrupt. So what did we have to do? Go out and buy insurance on our insurance. We had to buy insurance on Bear Stearns to protect our original insurance policy. And that is contagion in a nutshell, okay? Whether it's a country, whether it's a company, the knock-on effects due to counterparty risk lead to leverage unwinds. You can set your watch by it. It's that simple. So I've lived through 5 of these crises, started with long-term capital management started with the LDC debt crisis in 1988, then long-term capital management, 1998, 2008, then the COVID crisis, and guess what? This one is the worst of all of them because all you've done is kick the can down the road, or think of it as kicking it to the highest level, the government debt level. There's nowhere else to kick it, people. There's no higher level of leverage than the governments and the sovereigns. So contagion was in 2008, 2009, Bear Stearns and Lehman. Replace that with country XYZ today. It's exactly the same problem.
Yeah, I think that's why Ray Dalio talks a lot about how this is the end of the long-term debt cycle, right? And you get to this point where all the debt moves up to the sovereign level. You know, in my opinion, one of the biggest misnomers in finance is the fact that U.S. Treasuries are considered risk-free. And Jesse, I was wondering, you know, you think about all these pensioners and all these retirees who have been pushed into these bonds, and I'm personally kind of worried about that in this new paradigm that we're in today. So maybe, Jesse, if you could talk about the risk associated with these sovereign bonds, and maybe that they're not all chalked up what they're meant to be, like in terms of their risks.
Yeah, so I think to start here, you have to remember, what is a bond? A bond is just a contract. You're paying money today to get more money in the future. And so you're purchasing yield in the future. But you have to be sure about that yield is worth it. You need to know that yield is actually above the true inflation rate. And is that really the case right now? We're anchored to 2% as the typical inflation rate. It's hammered into you. That's all you've been told your whole lives, is that the government's going to manage a 2% on average inflation rate. So you just have to beat 2% for a bond or any investment to make sense. But is that actually what's going on? And so if you look back over the last 15 years, we've averaged 8% addition to the money supply every year for the last 15 years. And do things feel like they are actually more or less flat in terms of their price over the last 15 years, back to the 2000s? It doesn't feel that way, certainly not with like housing or any of your big ticket items. So where is the risk in holding a bond in your portfolio? It's that hidden risk that you're not seeing of, are you keeping up with inflation? And so you think you are if you're getting a 3% yield and you're told that you just have to beat 2%. So maybe that's part of your portfolio. But all of you out there, you all have bonds in your portfolio. You probably have more bonds in your portfolio than you realize. If you were to go home and log into Vanguard or wherever your 401k is and actually dig into it, it's probably a significant part of your portfolio. And is that portion of your portfolio actually keeping up with the money printing and true inflation rates? Now we have inflation at 8%, but if you're looking at the 1980 basket of goods, inflation right now is actually 15%, and it's been above 5% for the last 10 years. So if you've been holding bonds, you're making that nominal yield that you think is a return on your investment, but you might have been losing ground this whole time, the last 15 years, and certainly in this environment.
All right, let's talk some Bitcoin and macro. I have
right.
a shirt that is really inspired by you.
Isn't it?
Right?
It's so sweet.
It's the Do the Math shirt.
And who are the guys that make that?
FOMO 21.
That's
Neil
right,
Jacobs.
FOMO 21.
Yeah.
So my daughter bought me the hat that
Okay.
says "Do the Math" for Father's Day.
Do people come up to you and say, what's that about?
I keep it on the shelf in my office, actually. So when people come into the office sometimes, but I've worn it around. A couple of people ask me about it, you know, not too much.
I mean, it's simple math according to you.
It is simple math.
So what's going on with it? I mean, it's been a couple months since we last talked.
Okay.
I think it was in Amsterdam.
Okay.
We were talking about zombie banks.
I'm thinking
we were
things
talking
are
about
breaking.
credit.
You're
Okay.
watching Credit Suisse break in real time. Now, Credit Suisse is a systemically important financial institution, and there's a run on the bank. The wealth division is losing assets in magnificent fashion, and that's a very key profit driver for the bank. And it's essentially a run on the bank. And if CSFB gets in trouble, it's not just about CSFB, it's about all the other institutions that have exposure or counterparty risk.
What's CFSB?
Oh, sorry, Credit Suisse. I call
okay,
it
that's
Credit
what it-
Suisse for First Boston because
Okay.
that's my old CSFB is in my days when I traded. That's how but now they're just down to Credit Suisse.
Okay.
Yeah, they bought First Boston, a big investment bank in New York, and then they were CSFB for the longest time, and now they pared down to CS.
Why that one as a first domino?
Because it's in big capital trouble. It's only got a $10 billion market cap for about $1 trillion of assets, which is ridiculously low. And they'll say, oh, well, we meet BIS capital standards, but the problem is BIS capital standards doesn't mark to market. Okay, I don't want to get too granular with you, but the reality is their market cap at 10 billion is really just a rounding error. And I'm not saying that they're insolvent, but I've seen enough banks in that situation that are insolvent, and that is very, very scary.
On stage yesterday, you talked about how you see Bitcoin as an insurance policy.
Yes.
You talk about the credit default swap. So for those that maybe aren't as familiar with that, why do you refer to it as insurance policy?
Okay, thank you for the question. That's not grade 11 math when I start talking about credit default swaps. But I was a credit trader for 30 years. And I like to think of Bitcoin as an insurance policy on the fiat Ponzi. Okay, now it's absolutely 100% certain that the fiat Ponzi will fail. It's just a matter of when. And it's like owning fire insurance on your house. You don't ever want your house to burn down, but let's say you see on the other side of a valley a forest fire. Well, if the forest fire is approaching your house, you know that you're in trouble. You'd certainly want to own insurance. And you don't trade that insurance. You keep that insurance. It's not, and I like to think of Bitcoin as the same thing. It's insurance on the fiat Ponzi that's extremely cheap, and yet lots of people are inclined to buy and sell it. And I'm like, you don't sell your fire insurance on your house, much like you don't sell Bitcoin as your insurance policy on the fiat Ponzi.
Well, right now, a lot of people are talking not only about commercial and traditional banks, but the crypto banks. And it seems like there's an effort by the current administration to choke off some of the on-ramps. So Silvergate right now in the headlines. Can you share any thoughts or reaction on what's happening?
It's concerning. The reality is they are all small banks that can easily lose their position in the market. There's Silvergate, and I'm forgetting the second one. It's a little Signature, correct? It's a little larger. This is primarily for crypto on-ramps and stable coins. That for the buy and hodl self-custody Bitcoin person, we shouldn't think too much about it. But the reality is it impacts the ecosystem and the broader crypto ecosystem. So yeah, it's like an FTX type of event that will impact the asset class.
I was really surprised because I was talking to someone just here at the ski summit who runs a company in the space, and they were debanked over the last several years. First it was, I think, Wells Fargo, then Chase, and now they're with a state bank. And the FDIC came to that state bank and said, no, you should not be working with these companies. And then they fought back and they actually won. They said it was an overreach, but Caitlin Long as well, she was on my show, and she said we're in the midst of a debanking wave. And I think it could hurt Bitcoin adoption, at least in the short term, right?
Can it hurt Bitcoin adoption? It might actually promote Bitcoin adoption. But what it hurts is the larger institutions that need that on-ramp that's not like, buying and self-custodying Bitcoin. They need a custodian. They need the liquidity providers, custody. When you're managing a much larger pool of money, you need these on and off ramps.
What are you watching right now in this space? What are you most curious about? Because I don't know if you get this sentiment or this feeling, but when I talk to people in Bitcoin right now, it's almost as if we're in some sort of like a holding pattern, waiting for something to happen, waiting for a credit event, waiting for maybe the bull market or the pivot. Do you feel that way, or what are you watching right now?
I try not to overthink it in terms of, defining a pivot. I certainly am watching CSFB. My dashboard is very small right now, meaning, when I traded, I would have a dashboard every morning. You check, where's the Dixie, which is the DXY, the strength of the US dollar, where are US 10 years, are banks up or down, where is gold? And I think you can distill it into a couple of trades that you don't have to have a dashboard with 25 different things on it. But I already brought up one of them. Watch Credit Suisse, watch CDS, and it's more difficult to watch credit default swaps on CS, Credit Suisse, but you can everyone can watch the stock price, okay? So the stock price recently broke below $3 a share, which was like the line in the sand. And you throw out concerns like, we already know it's insolvent. It's just a question of, does the market take it to that point? So, I'm worried about US 10 years, which are hovering around 4%, and CS First Boston. And here's the big one, commercial mortgage-backed securities. Okay, I think that the subprime mortgage crisis in 2008, 2009, which basically drove the great financial crisis, I think this one is commercial mortgage-backed securities. So you've already seen Brookfield, one of Canada's largest office managers, default on a Los Angeles property. You've seen BlackRock default. And who are the people that own the mortgages? The banks. Or they've been securitized and sold out into the market. So commercial mortgage-backed securities, watch CMBS. So here are the three. US 10 years, CMBS, CS, Credit Suisse. I call them Credit Suisse First Boston because I'm an old fogey, but Credit Suisse.